This is Tom Aspray with the Viper Market Wrap video for the week ending December 13th. Well, the market survived the CPI and the PPI report, even though the PPI report was a little hotter than expected, had not a lot of reaction afterwards, but of course on Friday the market sort of soured on the numbers heading into this week's FOMC meeting. Expectations are for a 25 basis point cut. Everyone seems quite certain of that, which always makes me nervous. And certainly if we don't get it, we're likely to see a brief bout of panic selling. There were quite a few changes in the market. You can see this table was in last week's video. As of the December 6th close, you can see that pretty much all the markets were above their 20-day EMA. NYSE was the closest at up 0.5%. NASDAQ was 3.1. Only the IWM AD line, daily AD line, was negative, and we were pretty close to some of the weekly Stark bands. This is this week's table. You can see that all the daily AD lines are negative. SPY is down below its 20-day EMA, 2.6% above it, still in the Qs. All the rest of them are below it, and you can see the gap, has widened. Okay, they were up near the weekly Stark band, extended on the upside. Now, not so much. So, what does the negative daily AD lines mean? You can see some of the weekly are also negative. When this happens, then we look to see whether very key support levels are going to be violated, and then from a tactic standpoint, you kind of look at what the potential downside targets are, whether they're far enough to warrant just raising your stops or exiting the market or buying inverse ETFs. We're definitely not in the inverse ETF stage, but let's take a look at what I'm thinking. This chart is the S&P 500, the cash. You can see that the daily chart looks, fine. Just a sideways action here after the prior week. We made the high here at 699. The futures were higher, and the futures did generate a 260 sell signal on Friday. So that's another piece of the weight of the evidence. This last high here, 6017 from early, the post-election rally, and then the pullback, another new high. So minor support there. That's not that far below where we are. More important support here goes back to the October high at 58.84. If we got down there, there'd be roughly a 2.7% correction from where we closed on Friday, or if we were to get back to the September high at 57.71, that'd be a 4.6% correction. So what's the AD lines telling us? You can see the AD line daily made a new high, weekly made a new high, and so that's positive for the intermediate and longer term, as is the monthly. The daily is a little trickier. So we've basically been below it since a week ago here, and now dropped below this uptrend here, this blue line. So still above this low, and most importantly above these two lows going back to October and November. So if we were to break below those lows, then the top formation would become more negative, and that would suggest more of the 4.6% pullback as opposed to the 2.7. Until that occurs, you can't rule out that this is just the market consolidating before it heads back higher. That would be consistent with what we see in the SPY, as the weekly S&P AD line has closed fractionally, and I mean, we're talking maybe 30 issues below its still slightly rising weighted moving average here in green. So if we were to turn around with positive AD numbers next week, this thing would just turn right back up, and and we could get up to the 626, 630 area in the Stark band. Keep thinking that we're likely to get to that level before a significant correction. Last week's actions raises some questions. Once again, we look at the weight of the evidence. Since the QQQ is still leading the way, and based on the relative performance analysis, still leading the S&P, it's what we focus on. And the weekly chart still looks strong here. Another higher close. You can see that support goes back to July in the 503 area. And, if we were to drop back to that, that'd be about a 5% decline from where we are right now. If we were to get back to the 20-week EMA here in red at 493, that'd be more like a 6.8% correction. You can see that the weekly AD line is still positive. It has declined. The OBV is also positive. The daily chart shows that a doji was formed on Friday, and the daily AD line dropped below its moving average, which is clearly still rising. So for a more serious top to develop in the QQQ or the NASDAQ 100, you'd look for, a decline, that gets back to these lows, and then a rally back to the moving average, which at that point would be flattening to rolling over, and that would be consistent with a intermediate term pullback. Don't see that in the cards right now, but let's look at the rest of the charts. Another thing that changed last week was interest rates pretty much higher every day since we bottomed here on December 6th. The 10-year note yield has gone from 4.150 up to 4.399. So it's right back up into this resistance. The daily MACDs formed nice divergences at the highs, but are now flipped back to positive. We're at the daily Stark band, and of course with the FOMC meeting that we're all assuming will lower rates. Interesting behavior here. If you look at the 2-year, it's also started to act a little bit better late in the week. And if yields are really going to move higher, not lower, this is the one you want to watch. So certainly, this old high here was 4.381. A close back above that would just say this is just a pause in the overall higher trend towards higher yields. It is likely this action in the bond market late in the week that helped contribute to the selling, even though there was no really negative news from the inflation data. This is a daily chart of the NYSE Composite. You can see it's already declined back to its 50-day moving average in pink here at 19,777. It closed it below that at 19,729. 100-day next target is at 19,329. So this is sort of a sign that the common stock is, which had been finally catching up with everything else, didn't have a great week. You can see S&P 500 AD line on a daily basis is below its EMA and back to the breakout level, still above this support. Stocks only in red here also did make a new high, at the end of November, and is above this support level here, and of course the longer term uptrend. So if we break these lows, then I would expect this support to hold. And lastly, the NYSE all AD line also closed negative, but also made a new high with the market. We looked before at the QQQs and the daily AD line dropping below its WMA as well as its EMA. Didn't able to show you the RS action, which is quite positive for the QQQ acting better than the SPY. Oftentimes people misinterpret this, however, and what the RS tells you is that it's going to be stronger. So if the SPY declines, that indicates that QQQ will decline less. Of course, in an uptrend, it will gain more than the SPY. But that's an important distinction to make. If we do correct, you're going to be cushioned better in the QQQ than you would be in the SPY. This is another one of the worrisome things I was seeing last week. You can see, this is the percentage of S&P stocks closing higher. We haven't had a positive reading here for almost 2 weeks. So on Friday, 34% were lower. 1,500 too, after this big surge of strong action. That's not normally what you'd like to see. We saw back in here in August, and then we had follow through. We're not. And even now in the QQQs, it was holding on, but 56% were lower on Friday. That's why we formed the doji, and that's why the daily AD line closed negative. Also, some red flags from the high-low analysis. New highs dropped to 40 on Friday, and new lows up to 113. This suggests that the odds are we're going to take out this high next week, which would be consistent with more selling. And the NASDAQ composite, similar sort of action, 129, 227. So those both flipped to negative. So, we'll be watching that as the week continues. As consistent with the RS analysis, growth is outperforming value last week by a wide margin. You can see this, the ratio is up 2.3%, pushing the MACDs further into positive territory. On the plus side here, this is the NYSE Advanced Minus Decline Oscillator. So it just looks at the day-to-day net change, and this is a 5-day EMA in purple. So you can see we got moderately overbought here on the 25th of November, right as the market was peaking up in here, and as it was peaking, the oscillator started to turn lower. Now it's down to 705. You can see that 1,000 minus 1,000 is often a time, minus 1235 at the April lows is where we turn back up. So this is getting oversold. That suggests that, if we see some heavy put buying on Monday or Tuesday, we're set up for a rally back into the FOMC. Surprised that, we got the weekly sell signals here showing up on the sector ETF table. SMH got a daily buy on Friday, so that was encouraging, but, it's 3 is positive also. So, maybe in this environment, it hasn't been doing anything positive for the past couple of months, so maybe that'll change. Looking at the sector report, you can see energy has really been plunging, the relative performance here, 16.7. A few green spots here, but not too much. So something Hess just flashed a 3-day, so that makes it likely that Hess will give a weekly sell in the near future. Materials, also lots of red. Only one daily DTS and ECL, but and a 1 hour, which it could mean just a pause in a downtrend. Industrials, also getting a lot more red there. Honeywell still positive 3D and weekly, but it's negative across the board except it's 4 hours. So this is one you watch. Okay, is this going to get more positive? So we're going to flip a daily. If you flip a daily and these are positive, that would be a good sign. Consumer discretionary, the relative, look at the difference between industrials and consumer discretionary. Tells you which one you want to be in. Healthcare, not it. You can see that this is, this goes back to September. And just following this, if you had any healthcare, United Healthcare, anything else, you would have been saved some money. This, I'm a little surprised how far it's gone below this. So, to suggest this is just a pause in the uptrend of financials, time is running out for that. The banks and end up are back to pretty good support, but that support is being tested, and we can't rule out a downdraft. Interesting action in XLK. It just kind of hooked back above its moving average here, so maybe Friday's selling in some of the growth names was overdone. Communications services, XLC, is still a gangbuster, and utilities negative, and REITs negative. I mentioned last week, but also the case this week, there are a few daily buy signals, doji buy signals, but when the AD lines are negative like they are, I generally don't follow them. There are a few stocks, that are likely bucking the trend, but typically when you see this number of weekly doji sell signals, and then also you get a sell scan that has this many names on it, that's generally, is a sign that you want to be looking for a bounce to do some trading on the short side. So I'll be watching the action early in the week. If we get a rally that's just, lasts a couple of days and doesn't get back above the 20-day EMAs, it could weaken the technical outlook. As always, I'll be updating you on Twitter if that occurs. If you're just watching the first Viper Report video, we have a large number of them online here. You can go back week to week and see what we were saying at various points in time. And, of course, you can also do that with Forbes. This is a list of some of the most recent videos here. And, of course, right before the election, we talked about the AD line analysis that said, hey, we don't know who's going to win, but it's going to be bullish for stocks. That's still how we feel about the markets. I hope you found the video beneficial. And if you'd like to see some in-depth teaching on the stock market and some of the nuances I've gained in working with it for over 40 years, you might take advantage of this special offer, half off my advanced decline line course. I think you'll find it one of the better investments you're likely to make in 2025. Thank you.